The time value of money is one of the essential concepts of finance. In this video, we're going to explain what it means and why it's so important. The time value of money comes down to a very simple idea. A sum of money in the present is worth more than that same sum at a future point in time. The reason for that is that there is a base assumption that some rate of return can be earned on that money between now and whatever point in the future that same sum is proposed to be issued. To take a simple example, if I offer you $100 today or $100 1 year from now, you would clearly prefer to have the $100 today. Interest rates are about 5%, so to use that as an easy round number, you got that $100 today, you could put it in the bank and hope to earn 5% interest over the course of the year. At the end of the year, you would have $105, while the person that agreed to take that $100 1 year in the future is basically short $5 that they otherwise could have had. This has major implications for individuals, for companies, and for economies. At a personal level, you should always look at promises for capital through the lens of when that money will arrive to you. A paycheck today is very, very different than the potential for a payout from your startup equity a couple years down the line, or perhaps at an indeterminate time in the future. So when someone agrees to work at a startup and part of their perceived compensation is the potentiality that their equity will turn into capital at some point in the future, not only do you need to discount that value by the probability that liquidity event will actually happen and the company gets acquired or goes public, but you also need to discount it on the basis of the time that it will take for that capital to actually reach your bank account. Could you just make more in salary, invest it, get a rate of return on that investment, and potentially make the same amount over that course of time and have access to that capital in the intervening years? That's the time value of money. At an investor level, at an institution level, someone that manages a pension fund will also be very conscientious to the time value of money. Some of their pensioners may retire next year, and so an investment that will not be liquid until 10 years in the future is not as valuable to the pension fund that needs to pay out its pensioners starting next year. Companies navigate this issue all the time. When you sign a contract for a software, for a service, it's very common that they will give you a discount for signing up for an annual plan right now in the present versus agreeing to a monthly subscription. The reason for that is that the company knows they're growing at an accelerated rate, and if they can get proportionally less capital but get it all right now in the present, they will be able to compound that and grow faster than the discount rate that they've offered you for being a monthly subscriber. Once you learn this concept, you'll realize the time value of money is everywhere, and if you learn how to use it effectively, it can help to make you rich. Hope you found this valuable. Let me know in the comments below what financial concept you want us to cover next.